The market is currently closed for the weekend, having concluded the last trading session on Friday, December 5th, 2025, at a closing price of $27.49 per share, which represented a sharp decline of minus 6.15% for SoFi Technologies Inc. on the day. That kind of drop, on a day where the broader Nasdaq was actually seeing modest gains, tells you everything you need to know about where the immediate pressure point lies for SoFi right now. This is a classic tension between expectation and reality. The expectation among the long-term holders and momentum traders has been that SoFi, having achieved GAAP profitability and continued to show strong member growth, was on a smooth path to being re-rated as a true growth bank. But the reality that slammed the stock down on Friday was the announcement of a massive $1.5 billion public offering of common stock, priced at $27.50 per share, which immediately created significant dilution concerns and essentially established a short-term price ceiling for the equity. This move by management, while strategically sound for strengthening the balance sheet, completely blindsided a market that had been running the stock up aggressively in the prior weeks. And this disconnect is precisely what we need to unpack to understand the stock's direction going forward. The immediate market reaction was brutal, and the volume behind the move was undeniable. Trading volume for SoFi on Friday spiked to well over 170 million shares, dwarfing the average daily volume of roughly 75 million shares. This signals heavy institutional movement, specifically a flight from the short-term speculative trade and a repricing of the equity to reflect the impending dilution. The open price on Friday was already below the previous close, and the stock traded in a tight, downward-sloping channel throughout the day, hitting a low of $26.93 before staging a minor, unconvincing rebound into the close. This price action is not indicative of panic selling by retail investors, but rather a cold, calculated revaluation by large players who are adjusting their models to account for the approximately 54.55 million new shares entering the float. The general belief, often amplified on social media platforms, is that any stock offering is a sign of weakness or a move to cash out at elevated prices. We see posts across Reddit and X suggesting the company is selling at a top or that this is a direct attack on retail shareholders. However, the contrarian, deeper take is that SoFi is seizing a high stock price, one that is up over 70% year-to-date, to raise non-debt capital cheaply, not out of desperation, but to fortify the bank charter's capital ratios and fund future growth, potentially for a strategic acquisition, which could actually be a massive long-term benefit. The reality is that the new capital enhances their lending capacity and increases their regulatory flexibility, which for a hybrid tech and bank entity is arguably more valuable than avoiding short-term dilution. Looking closer at the technical picture, the sharp sell-off pushed SoFi stock decisively below its 100-day moving average, a level that had previously acted as a psychological support. Breaking that line signals a shift in the near-term momentum and suggests that the short-term bullish narrative has been severely compromised. We now need to monitor whether the stock can hold the $26.90 support level, which was Friday's intraday low, or if the downward pressure from the dilution overhang will push it back toward the low to mid-$20 range in the coming weeks. The technical setup is clearly bearish right now, and until the market fully absorbs this new share supply, expect volatility and potentially lower lows. The institutional activity filing data, though slightly lagged, provides important context. The latest 13F filings from November 2025 for the September 30th quarter already showed major institutional investors like Vanguard Group, BlackRock, and notably JP Morgan Chase significantly increasing their long positions, a sign that sophisticated money was betting on the profitability and bank charter story. This offering is testing the conviction of those very institutions, forcing them to weigh their long-term thesis against the short-term capital structure shock. It is critical to watch how they act in the next filing cycle. If we see a significant capitulation in institutional holdings, that would signal a fundamental breakdown in the confidence of the growth story. Now, let's address the short-selling awareness, which is highly pertinent given the sudden price drop. SoFi has consistently been a target for short sellers, a common theme for high-growth fintech companies with premium valuations. The short interest data from late November 2025 indicates a significant number of shares sold short, over 116 million shares, representing a short interest percentage of the float around 9.80%. While not in meme stock territory, which is typically 20% or higher, a near 10% short interest is meaningful and creates constant downside pressure. More importantly, the days-to-cover ratio, which measures how many days of average trading volume it would take for short sellers to cover their positions, stands at approximately 2.61 days. This is a relatively low figure, meaning that if a positive catalyst were to emerge, the risk of a swift short squeeze is moderate but not extreme. What is more alarming for the bulls is the off-exchange short volume ratio, which has recently been reported around 40% of the total short volume. This high dark pool short activity often correlates with institutional hedging or coordinated selling pressure, a tactic that can exacerbate a price decline like the one we just witnessed. The low borrow rate for the stock, currently at around a fraction of a percent, suggests that it's cheap for short sellers to maintain their positions, removing the financial pressure that often forces a short squeeze. For retail investors trying to figure out what to do with the SoFi short thesis, there are actionable steps. First, track the short interest data, which is typically updated semi-monthly. An increase above 10% coupled with a spike in the days-to-cover ratio would suggest escalating bearish conviction and heightened squeeze risk. Second, monitor the borrow cost. If the cost to borrow shares starts to climb, that's a signal of increased demand from short sellers and tightening supply, which is a precursor to a potential squeeze. The current situation suggests the shorts felt vindicated by the dilution news and may now be adding to their positions or simply holding, believing the valuation is still rich. You need to look for signs that the short thesis, which centers on competitive pressure on lending margins and the high cost of customer acquisition, is being fundamentally disproven by the company's operating results, not just hoping for a quick squeeze. The recent dilution has given the short sellers fresh ammunition. Do you think the government will pass legislation in favor of the cannabis industry anytime soon? Let's get back on topic. Specifically, comment below how many shares of SoFi Technologies you currently hold and what your price target is, because understanding the retail sentiment here is critical. The company's core business model, which often gets lost in the daily volatility, is a truly compelling aspect of the long-term bullish case. SoFi started as a student loan refinancing platform, but has brilliantly evolved into a vertically integrated, one-stop digital financial services company, often described as a financial services supermarket. Its three main segments are lending, its core cash generator, technology platform, which includes Galileo and Technesis, and services roughly 160 million accounts globally, providing a capital-light, high-margin revenue stream, and financial services, which houses its bank accounts, credit cards, and investing platform. The key here is the vertical integration afforded by its national bank charter. This charter allows it to hold loans on its balance sheet, eliminating the reliance on third-party funding, significantly reducing its cost of funding, and driving its profitability. This is a massive structural advantage over non-bank fintech companies like Robinhood or others that rely on bank partners. Recent quarterly results from September 30th, 2025 underscored this strength. Record net revenue of $962 million and a second consecutive quarter of GAAP net income of $139 million. Customer growth has been consistently strong, adding millions of new members, which is the engine for cross-selling its expanding product suite. The expectation is that the low-cost funding from its SoFi Bank deposits, combined with the high-margin technology platform revenue, will eventually create a powerful flywheel of sustainable, profitable growth. The reality is that the stock's current price, even after the dip, already discounts a lot of that expected growth. A forward price-to-earnings ratio in the range of 50 to 70x, depending on which forward estimates you use, suggests a very high bar for execution. Moving into the future outlook, the catalyst most likely to overcome the dilution shock is continued execution in the technology platform and evidence of judicious use of the newly raised capital. If the $1.5 billion is deployed to accelerate the growth of Galileo or to facilitate a strategic acquisition that brings in a large, sticky customer base or a new high-margin vertical, the dilution will be quickly forgotten. The primary risks remain the macroeconomic environment, particularly higher for longer interest rates, which affect loan demand and credit quality, as well as the inherent competitive pressures in the fintech sector. SoFi needs to demonstrate that the net interest margin improvements from the bank charter are sustainable and that its lending business can weather a potential economic slowdown. For investors, the next critical signposts will be the Q4 2025 earnings call and any forward guidance on capital deployment. The tension remains high. The market expects a swift return to growth,